Asian markets responded negatively to news that Donald Trump's administration will impose import tariffs of 25% on Mexican and Canadian goods, with plans to add an additional 10 percentage points on tariff imports from China. Market players have been anxious about the possibility of the imposition of tariffs, and while this is not good news, at least this gives some clarity around what the future looks like. The Nikkei share average declined by 0.87%. The Hang Seng Index rose by 0.04%. While the Shanghai Composite Index declined by 0.12%. US markets ended the session in positive territory. This as market players gave the thumbs up to President-elect Donald Trump's pick for Treasury Secretary Fund Manager Scott Bessent. Market players believe that he may assist in watering down Trump's more radical approach to protectionist policies. The Dow Jones Industrial Average rose by 0.99%. Let's just call that 1%. The S&P 500 ended the session up 0.3%, while the Nasdaq Composite Index gained 0.27%. Here at home, the all-share index is currently trading 0.4% to the good, trading at around 85,269 index points. The rand is trading at 18.12 against the US dollar, 22.75 vis-a-vis the British pound, and 18 on the dot against the euro. Looking at commodities, gold is trading at $2,626 and platinum at $929 per ounce, while Brent crude oil is trading at $73.26 a barrel. I'm joined by Tumisho Greta. She's a multi-manager investment analyst at Nedbank. A very good afternoon to you, Tumisho. So President Trump appears to be getting clearer on his tariff plans, looking to impose 25% on Mexican and Canadian goods, while adding 10 percentage points on existing Chinese import tariffs. What are the ramifications of this going to be on the global economy and in turn on markets?
Thank you so much for having me, Anopu. Yeah, it's been quite interesting because as you've just doing your market update, we saw that your Asian markets were, a little bit mixed, but we saw US markets hitting new all-time highs because we have this new, appointment by the US president-elect, who is said to be a lot more, cautious when it comes to putting those tariffs into play. So one of the things I think, I'm going to go through maybe just a list of two or three things that I think would be important for us. So firstly, if you are looking at having, a higher tariffs, obviously this would be a negative or more inflationary. And secondly, if you were looking at, Trump's policies, who also have quite a big impact on immigration. So if you look at the period between 2019 and 2024 as an example, what's interesting is that about more than 80% of the labor force was actually made up of foreign nationals. So if that was going to be removed, you obviously be sitting with a labor force that, for one, may actually come at a higher cost, which again would be quite inflationary. So there you are. And another point would be the impact that Donald Trump or the president-elect would have. And one of those things would be the fact that we would see looser regulation around, say, the banking sector, having more crypto-friendly type of policies. So which is why you also saw the likes of your AI-focused stocks or your tech-heavy stocks like the Nasdaq doing very, very well. So there are various implications for this. I suppose if you look at just the US markets, if you are in a position where they are having tariffs and the smaller businesses within the US are likely to do well because they are going to be protected. But looking at the global economy and also longer term implications for inflation, if you do have higher tariffs coming through, this could also push up the cost of doing business as well. And this, of course, would mean that this is going to put up inflation and could result in interest rates perhaps not going as low as we would have liked them to be.
Yeah, well, from your response there, all I can hear is inflation, inflation, inflation. So China is going to be hard hit by these developments, and this negativity was reflected in the market performance today. What will this mean for China's demand for commodities from countries like South Africa?
No, certainly. I mean, looking at, the impact that China is currently feeling, I mean, one of the things that has been key during, I think, the Chinese narrative is whether or not we are looking at a much weaker China in terms of its growth prospects. Now, China is the world's or second largest consumer of oil. And if it's growing at a lower rate, it would actually then translate in having less demand for this particular commodity. So that is one of the things that's going to have an impact on the demand that we would need for that particular commodity. South Africa exports a lot of gold and platinum to the Chinese market. So again, if we are in a position where China is going to be growing a lot slower, and if the impact of these tariffs is going to come through in its supply chains and slow down economic growth, this would mean that we would be exporting less. So, we cannot ignore China when it comes to the commodities complex and, of course, the impact that it has on South Africa as well.
Given the overarching concern about inflation, what does it mean for us here at home in the South African market? Can we kiss goodbye any further interest rate cuts?
That's a difficult one. I mean, you'll remember last week when the governor was saying that, 50 basis points was not even put forward as an option. It was 25 basis points, and that was a unanimous decision. And one of the things that he spoke about was the global environment, but also things from a domestic perspective, such as, higher wages, higher administrative prices, so high electricity costs, higher water costs being one of those things. And of course, we never really know what's going to happen in terms of geopolitics and the impact that this could also have on the oil price. And then, of course, will also feed into inflationary pressures. One of the things I think is also helpful to look at, when we look at what may happen in the future, but also it's really good to take a little bit of a rear view. If you look at, say, 2021, we've just come out of COVID, and this was a time when interest rates were going up, where inflation had really started to skyrocket. So there are, similar similarities or similar points that we are seeing now between 2021 and where we are now. So we're seeing, looser fiscal position, especially in the US. We're seeing a looser monetary policy, or we are, seeing more accommodative monetary policy stance, and of course the impact of the tariffs. So, those are just some of the things that we are seeing that happened then and that are happening now. And granted, we had just come out of COVID, so, the situation was different, but there are those things that we do need to keep an eye out on. So I think, just to be clear, I think it's important that we're not complacent when it comes to the inflation picture, because there are so many other variables that could cause the US Reserve Bank to not cut interest rates if inflation surprises on the upside. And then, of course, South Africa, if the US has a cold and they sneeze, we will also catch that cold. So that would mean that if there's inflationary pressure coming through from the rest of the world, we will also inherit that. So lower, or say less deep interest rate cuts that we can expect from our side, if that's the situation that transpires.
All right, Tamisha, we'll wait and see what transpires. Thank you so much for your time. Tamisha Greater, she's a multi-manager investment analyst at Nedbank.